Good morning students, I am Sailaja. Today I would like to explain about financial statement analysis and funds flow and cash flow statements. In the previous classes you learned about the concept of the accounting principles, journal entries, ledgers, the trial balances and the final accounts. In this class I would like to explain about financial statement analysis in managerial economics and financial accounting subject. Let us enter into the topic. Financial statement analysis, which includes gaining an idea of an entity's the financial situation by analyzing the financial statements of the company. You will also having the three main financial statements. One is the statement of income, the balance sheet and the cash flow statements. The analysis of these financial statements is also submitted to the board of directors and senior management committees because they use the information in their decision making process as input. This research is also used by third stakeholders and such as regulatory authorities and investors to gain insight into the organization. Once the preparation of final account is over, then we analyze these accounts. So that means you already prepared about the final accounts like trading account, profit and loss account and balance sheet. Once the final accounts are preparation is over, then now it is time to analyze the accounts. Analysis of the profit and loss account and the balance sheet, which leaves the financial position of the company and the ratio analysis also. What is the meaning of financial statement analysis? The term financial analysis, also known as analysis and interpretation of financial statements, and which refers to the process of determining financial strengths and weaknesses of the firm by establishing strategic relationship between the items of the balance sheet, profit and loss account and other operative data. General financial statements are centered around financial statements are the accounting reports prepared by company. They are historically record of the finances of the company over a period time. Investors use financial statement analysis as the basis of their investment opinion on the company. So these financial statements can be prepared internally or by the company's auditors also, the outside accountants used by the firm. So that to analyze about the financial statement, to analyze about the accounting, it is very important, it is very necessary. And what is the definition of financial statement analysis? Analyzing financial statements according to Metcalfe and Titrata, it is a process of evaluating the relation between component parts of the financial statement to obtain a better understanding of the firm's position and performance. In other words, they define about the financial statement analysis is largely a study of a relationship among the various financial factors in a business as disclosed by a single set of statements and a study of the trend of these factors shown in the series of statements also. And generally accepted accounting principles in the US. These principles required a company to create and maintain three main financial statements. One is the balance sheet, the income statement and the cash flow statement. Public companies have strictly understand for financial statement reporting. Public companies must follow GAAP standards which require accurate accounting. But the private companies have greater flexibility in their financial statement, the preparation, and also have the option to use either accrual or cash accounting. Okay. And there are different techniques of financial statement analysis. Various techniques are used in the analysis of the financial data to emphasize the comparative and relative important data presented and to evaluate the position of the firm. Among the more widely used of these techniques are the following here. The first one is horizontal analysis. The second one is vertical analysis. The third one is trend analysis. And the fourth one is ratio analysis. Horizontal analysis, vertical analysis, trend analysis, and ratio analysis. Horizontal analysis. The first one is horizontal analysis. The percentage analysis of increasing and decreasing in corresponding items in comparative financial statements are called horizontal analysis. Horizontal analysis involves the computation of amount changes and percentage changes from the previous to the current year. The amount of each item on the most recent statement is compared with the corresponding item on one or more earlier statements. Okay, and the vertical analysis. Vertical analysis uses percentages to show the relationship of the different parts to the total in a single statement. Vertical analysis sets a total figure in the statement equal to 100% and computes the percentage of each component at that figure. Okay, this is vertical analysis. And third one, trend analysis. It is also known as a pyramid method. Studying the operational results and financial position over a series of years is trend analysis. Calculation of ratios of different items for various periods is also done and then compared under this analysis also. Whether the enterprise is trending upwards or downwards. The analysis of the ratios over a period of year is done. By observing this analysis, the sign of good or poor management is detected also. Okay, and the fourth one is ratio analysis. Quantitative analysis of information contained in a company's financial statements is ratio analysis. It describes the significant relationship which exists between various items of a balance sheet and the statement of profit and loss of a firm. Okay. And next, what is the significance of financial analysis? For managers, it helps to the managers analysis of financial statement. How it helps to the financial managers? Assessing the operational efficiency and managerial effectiveness of the company, and also analyzing the financial strengths and weaknesses and credit worthiness of the company also. And it also helps analyzing the current position of the financial analysis, assessing the types of assets owning by the business enterprise and the liabilities which are due to the enterprise, and providing information about the cash position company is holding and how much debt the company has in relation to equity, and also studying the responsibility of stock and debtors and held by the company. This is the significance for the financial managers also. And for the top management, financial analysis, it helps to the top management to assess whether the resources of the firm are used in the most effective manner or not. and whether the financial conditions of the firm is sound or not, is in a good position or not. It also helps, the financial analysis helps to whether the financial condition of the firm is good condition or not, and to determine the success of the company's operations also, and appraising the individual performance, okay, and evaluating the system of internal control, and to investigate the future prospect of enterprise. This is the significance for the top management, okay. And let us see the second concept from this unit is, let us see the second concept from this lesson, the meaning of funds flow statement. Funds flow statement is a statement which discloses the analytical information about the different sources of a fund and the application of the same in an accounting cycle. It deals with the transactions which change the amount of current assets and current liabilities in the form of a decrease or increase in working capital or fixed assets or long-term loans including ownership fund also. So this is the meaning of a funds flow statement. So the definition about the funds flow statement. Funds flow statement implies a snapshot of the movement of funds. So inflows or outflows of the firm's financial assets of a specific period. It represents from where the funds are received and where the funds are utilized by the company during a particular period. The word fund refers to sum of money which is used to finance the firm day-to-day operations and acquire assets for the business. The funds flow, the flow of funds represents the movement of funds, that is the change in economic resources from one asset or liability to another. In this way, the funds flow statement implies a method of analyzing the changes in the firm's financial position between two balancing sheet dates also. Meaning, the meaning of a cash flow statement. A cash flow statement is a statement of changes in the financial position of the firm on cash basis. It relieves the net effects of the all business transactions of a firm during a period on cash and explains the reasons of changes in cash positions between two balance sheet dates. It shows the various sources, that is inflows, and applications, that is outflows of cash during a particular period and their net impact on the cash balance also. Okay, and the definition about the cash flow. The cash flow statements are the statements of changes in financial position prepared on the basis of funds which defined as cash or also the cash equivalents. The Institute of Cost and Works Accountants of India defines the cash flow statement as a statement setting out the flow of cash under distinct heads of sources of funds and their utilization to determine the requirements of cash during the given period and to prepare for its adequate position also. And what are the objectives of cash flow statement here? The main objectives are to provide information about cash flows and outflows from operating, investing and financing activities. So to determine the net changes in cash and cash equivalents, what are inflows and outflows of the cash here? Here, the inflows and outflows of cash is nothing but inflows of cash is all transactions that lead to an increase in cash, and cash equivalents are classified as inflows of cash. And outflows of cash, all transactions that lead to a decrease in cash, and cash equivalents are classified as outflows of cash. The features of a cash flow statement. It is periodically statement as it covers a particular period of time, okay, month or a year. It shows movement of cash in between two balance sheet dates, and it also establishes the relation between net profit and changes in cash position of the firm. It does not involve the matching of cost against the revenue. It shows the sources and applications of funds during a period of time. It records the changes in fixed assets as well as the current assets also. These are all the features of cash flow statement. And the main objective of the cash flows are, it shows the cash earning capability of the firm. It indicates the different sources from which cash can be collected and various purposes for which cash has been utilized during the year. And it also classifies cash flows during the period from operating, investing and financing activities. And it also helps the management in cash planning and control, so that there are no shortage or surplus of cash at any point of time. It evaluates the ability of the firm to meet obligations such as loan repayment, dividends, taxes and so on. Okay. The importance of a cash flow statement. Cash flow statement is useful for short-term planning and control of cash. A business entity needs a significant amount of cash to meet its various obligations in the near future, such as payment for purchase of fixed assets, payment of debts, operating expenses of the businesses, etc. It helps the financial manager to meet a cash flow projection for the immediate future, taken the data relating to cash flows and cash outflows from past records also. Such, it becomes easy for him to know the cash position which may either result in a surplus or a defect one. Thus, cash flow statement is another important tool for financial analysis of the management. And you can see here the difference between funds flow and cash flow statement. The basis of difference is the basis of analysis, cash flow and funds flow. Funds flow statement. Funds flow statement is based on broader concept, nothing but it is a working capital. Cash flow statement is based on narrow concept, nothing but it deals the cash, which is only one of the element of working capital. And the second one is the source. Funds flow statement tells about various sources from where the funds generated with various uses to which they are input. And cash flow statement states that opening balance of cash and reaches to the closing balance of cash by producing through sources and uses. And third one is usage. Cash flow usage. Funds flow statement is more useful in assessing the long range financial strategy. Cash flow statement is useful in understand the short range phenomenon affecting the liquidity of the business. And the fourth one is scheduling changes in working capital. In funds flow statement, changes in current assets and current liabilities are shown through the schedule of changes in working capital. And in cash flow statement, changes in current assets and current liabilities are shown in cash flow statement itself. And end result, funds flow statement shows the causes changes in net working capital. cash flow statement shows the causes in change in cash. And the last one is the principle of accounting. Funds flow statement is in alignment with accrual basis of accounting. And here in cash flow statement, the data obtained and accrual basis are converted into cash basis. So this is all about the difference between funds flow and cash flow. One is on the basis of analysis, sources, usage, schedule of changes in working capital, and result, and the principle of accounting. Okay. In this class, you learn about the concept of financial statement analysis and about the financial statement analysis, the meaning, the definition, and about the techniques of financial statement analysis. And another concept is funds flow and cash flow statements. So funds flow and cash flow statement, the meaning, the definitions, and about the other concepts of funds flow and cash flow analysis, and also what is the difference between the funds flow and cash flow. So here the financial statement analysis, which helps the firm to know about their liquidity positions also. Okay, so this is about the financial statement analysis. Thank you.